6 hours. That's all it took for $42 billion to vanish from a single bank. Silently, digitally, and faster than any bank run in human history. No lines outside branches, no crowds shouting for their money, just millions of taps. And the system cracked. What happened in March 2023 wasn't an isolated crisis. It was a signal, a glimpse into how fragile the modern banking system becomes when fear moves at the speed of the internet. Because today, a bank run doesn't look like it did in 1929. It's invisible. It's instant. And when it starts, no bank, no matter how respected, can survive the stampede of digital withdrawals. This is the part of the story they don't want you to see. Not the headlines, not the press conferences, but the real mechanics behind how money evaporates and why the next run could spread globally in minutes. To understand how a bank collapses in hours, you first need to understand a simple truth. The money in your bank account is not really there. Banks don't keep your deposits sitting safely in a vault. They lend most of it out, invest the rest, and keep only a tiny slice as liquid cash. This system is called fractional reserve banking, and it works until it doesn't. When you open your banking app and see a balance like $5,000, that number is not a pile of cash waiting for you. It's an IOU, a promise, a digital note saying, "We owe you $5,000 whenever you ask for it." The problem? If too many people ask at the same time, the bank simply doesn't have the money, because 90% to 97% of deposits are already locked in loans, mortgages, treasuries, or long-term investments. So when customers panic and start withdrawing, the bank has to scramble, selling assets quickly, often at a loss, just to meet demands. And in a world where withdrawals don't require standing in line, just a swipe on a phone, even a healthy-looking bank can run out of cash before lunch. This isn't mismanagement. It's the design of the system. A system that assumes people will never panic all at once. But in 2023, they did. And the world discovered how fast the illusion of stability can collapse. March 9th, 2023. Silicon Valley Bank started the day looking stable on paper. By the end of the night, it was already dying. Here's how the collapse unfolded, almost minute by minute. It began with a single announcement. SVB needed to raise billions in emergency capital after selling long-term bonds at a massive loss. To the public, it looked like a routine adjustment. To insiders, it was a neon warning sign. Then fear ignited. Founders, venture capitalists, and tech CEOs began texting each other, "Get your money out now!" One message became 100. 100 became tens of thousands. And just like that, the largest digital bank run in US history began. Customers didn't walk into branches. They used apps. They didn't wait in lines. They clicked withdraw. In 6 hours, over $42 billion flooded out of the bank. SVB tried to sell assets, tried to raise cash, tried to calm the storm. But nothing moves faster than panic in a hyper-connected economy. By the morning of March 10th, regulators stepped in. The bank was insolvent. The doors were locked. Billions were frozen. And the world realized a bank can now collapse at the speed of a group chat. When Silicon Valley Bank went down, regulators rushed to reassure the public. Depositors will be protected. The system is sound. Your money is safe. But behind the scenes was a math problem nobody wants to talk about. Let's start with the basics. In the US, deposits are insured by the FDIC, but only up to $250,000 per account. And here's the part they leave out. The FDIC does not have enough money to cover a nationwide crisis. Not even close. At the time of the SVB collapse, the FDIC insurance fund held around $128 billion. Sounds like a lot, until you compare it to the more than $9 trillion in insured deposits across American banks. That means the FDIC could cover about 1% of deposits if a large-scale bank run happened. So how did they save SVB's depositors, including the billions above the insurance limit. 2 words: emergency measures. The government designated SVB as a systemic risk event, allowing regulators to bypass normal rules and guarantee all deposits, insured or not. It was a one-time override, not a sustainable strategy. To plug the hole, the Fed created a special lending program where banks could borrow money using their underwater bonds as collateral, valued at full price, even though those bonds had massive unrealized losses. In other words, they let banks pretend their assets were worth more than they were. This quiet bailout worked temporarily. But the underlying math didn't change. If another major run happens, the FDIC cannot cover everyone. And that's the truth, hiding beneath every press conference. The system survives only as long as people believe it's safe. When people hear bank rescue, they think of bailouts. The government stepping in, printing money, and saving the day. But there's another mechanism most depositors have never heard of. And it's far more unsettling. It's called a bail-in. A bailout uses taxpayer money. A bail-in uses your money, the depositors, the creditors, and anyone the bank owes. Here's how it works. If a bank fails and regulators don't want to use public funds, they can legally convert certain liabilities into capital. That means your large deposits, your corporate accounts, your uninsured balances above $250,000 can be frozen, converted, or even used to recapitalize the bank. This isn't theory. It's already happened. In Cyprus, 2013, depositors woke up to find their accounts locked. Balances over a certain threshold were forcibly converted into bank shares. People lost access to life savings overnight. Businesses couldn't pay employees. Families were trapped. And here's the part that most Americans, Europeans, and Asians don't realize. Bail-ins are now written into law in many countries. After 2008, regulators worldwide agreed that taxpayers should not always be the ones rescuing banks. So, they built legal frameworks like the EU Bank Recovery and Resolution Directive and similar mechanisms in the US that allow failing banks to restructure by tapping creditors and uninsured depositors first. In plain English, if another major bank collapses and regulators decide not to bail it out, they have the authority to reach into large accounts to stabilize the institution. It's the reset button nobody talks about. And in a digital banking era where panic spreads instantly, the question isn't if the mechanism will be used again, but when. The story of modern banking isn't just about money. It's about politics, power, and a system held together by confidence. Confidence that can disappear in seconds. For decades, governments have repeated one promise: we will not let the system fail. But here's the uncomfortable reality. The system is now so large, so interconnected, and so fragile that no response is perfect anymore. When a big bank is in danger, regulators have 3 options. Bailouts, using public funds to save the institution. This prevents chaos, but creates moral hazard. If banks expect to be rescued, they take bigger risks, knowing taxpayers will clean up the mess. Bail-ins, using creditors and large depositors to absorb the losses. This avoids public anger about taxpayer money, but risks triggering panic nationwide. Because once people realize their deposits can be touched, trust evaporates instantly. Print money, the fastest and easiest option, but printing to patch holes leads to inflation, currency devaluation, and long-term instability. So every crisis becomes a political equation. Which decision causes the least damage right now? That's why you'll often hear the phrase, too big to fail. And some institutions are so deeply woven into the economy that letting them collapse would cause a chain reaction, wiping out businesses, freezing markets, and shutting down credit overnight. But here's the paradox. Saving them reinforces the very system that made them dangerous. This is the trap regulators face. Save the system today, weaken it tomorrow. Protect depositors now, increase risk later, Prevent panic this week, fuel a bigger crisis next year. And as banking becomes faster, more digital, and more interconnected, the fragile balance becomes harder to maintain. The truth is simple. The next major run will not be slowed by physical distance or branch hours. It will spread the social networks, group chats, and real-time fear, a chain reaction faster than any policy response, and that means the weakest point in the system isn't a single bank, it's confidence itself. So, what can ordinary people do in a system where stability depends on confidence? And confidence can vanish overnight. You don't need fear. You need a strategy. Because while you can't change the banking system, you can protect yourself from its weaknesses. Here are the most practical, high-impact moves. Stay under insurance limits. Always. In the US, keep deposits under $250,000 per account per institution. Use multiple banks if you need more coverage. The same principle applies worldwide. Stay within your country's insured threshold. Use multiple institutions, not just one. Spread your money across a major national bank, a local or regional bank, and NCUA-insured credit union. Diversification reduces the impact if any single bank freezes or limits withdrawals. Keep an emergency cash buffer. Not for investing, just for survival. When banks freeze withdrawals, even temporarily, cash becomes your safety net. Your goal: 3 months of expenses accessible in physical currency. Hold assets outside the banking system. Banks can lock deposits, but they can't lock what you store privately. Consider allocating part of your wealth to precious metals, gold, silver, short-term treasury bills, hard assets you control directly. These don't rely on a bank's liquidity. Use account structuring to maximize insurance. Joint accounts, business accounts, trust accounts. Each may have separate insurance categories depending on your country. A smart structure can legally multiply your protection. Keep a portion in extremely liquid, low-risk instruments. Many people tie up all their money in long-term investments. But a crisis needs liquidity. Use money market funds, not accounts. Treasury-only ETFs. Government-backed short-term notes. Monitor your bank's health proactively. Look at simple indicators. Stock volatility for public banks. Lending exposure. Commercial real estate dependence. Customer concentration. None of these guarantee safety, but they reveal risk patterns. Don't panic. Act early. The people who lose the most in crises are those who wait too long. If depositors sense trouble, withdrawals spike instantly. Preparation beats reaction every time. Have a plan for fast movement. In digital bank runs, speed matters. Know in advance where you would move funds, which accounts you can shift to, what limits your bank places on digital transfers. When the system is stressed, delays multiply. Build personal resilience. No matter what governments or regulators do, the strongest shield is a household that isn't vulnerable to sudden shocks. Reduce debt, increase savings, diversify income streams, become less dependent on any single institution. Because here's the real lesson from 2020. Suffering foncio. 3. The people who came out strongest weren't the wealthiest. They were the best prepared. When $42 billion vanished in 6 hours, it wasn't just a bank failure. It was a warning shot, a glimpse into how fast the modern financial system can crack when fear spreads at digital speed. The old rules are gone. There are no long lines outside branches, no slow motion collapses, no time for governments to react before the damage is done. Today, stability exists only as long as people believe it exists. But here's the good news. You don't need to be powerless. You don't need to be fearful. You simply need to understand the game and prepare for it. Because the world is changing. Banking is changing. Money itself is changing. And the people who stay informed, the people who protect their savings intelligently, the people who build resilience instead of relying on promises, they're the ones who come out stronger after every crisis. If this video opened your eyes, share it. If you learned something valuable, comment below. And if you want to stand with others who are waking up to these realities, join the community. Together we build quiet strength. Together we stay ahead of what's coming.